Hello and welcome everyone. In this video we will see Slack performed a direct listing instead of an IPO. What is the difference in layman's terms? Welcome to the question answer channel, the channel where you will find the answer to everything. Thanks to Kelly Battles, Asim Qureshi and John Framer for sharing their views with us. Let's go for Kelly Battles' first answer.
This is a fun question for me because I am very interested in this topic and have spent some time trying to understand it. Here is how I think about this question in what I am certain are overly simplistic terms. Capital. The main difference is that companies in a DPO are not raising capital, instead they are just listing their stock so it can be traded. No lockup. All existing owners can sell their shares immediately after a DPO. Relationship with bankers. In a DPO, bankers are advisors, not underwriters. Bankers don't set the price, they don't underwrite shares, they don't host a roadshow, they don't build a book of business. Mostly, it seems, the DPO bankers advise on how to file documents with the SEC and navigate these new waters. Trading support. Bankers tend to say that the biggest risk to a DPO is that, since banks are not involved in underwriting, there is no aftermarket support from the banks, which can lead to excessive price, trading volatility, especially in the early days of being public. In reality, this was not the case for either Spotify or Slack. Why do this? If you are a company considering this option, no lockups for employees and investors. A true market price is set with no conflicts of interests tolerated between underwriters and institutional investors. Lower transactions and underwriting fees. Some argue this point, but I think in general this is less costly to a company and will get even cheaper as the structure is better understood and more mainstream. Arguably, more control on the investment thesis, message. This is not for every company. Here are a few thoughts on ideal characteristics of companies who can pull this off. The typical characteristics of a public company. IPO or DPO. You still need material, predictable revenue, $100 million plus annual run rate, to be growing revenue healthfully. Best to be over 30% per year plus, steady state margins which depend on your business model, and clear path to both a $1 billion annual revenue business as well as to profitability. Brand. It helps to have a well-recognized brand name like Spotify, since banks are not necessarily going to be pushing your stock with their institutional clients. The sentiment used to be that DPO companies needed to be a strong consumer brand, but Slack has called this into question, in my opinion. Plenty of cash in the bank, cash flow positive or some combination. Since you aren't actually raising money in a DPO, but instead just providing liquidity for your shareholders, you need to be well capitalized so you can continue to grow, scale, operate your business. Potential for trading stability. Having a large, diverse shareholder base can provide sufficient supply-side liquidity in early trading, so you don't see early extreme trading volatility that scares investors. Executives and board members who are willing to let the market set the price, versus controlling this themselves, and who value controlling their message to investors centrally, versus a decentralized roadshow. I am very excited to see how this evolves over time, but my guess is that the DPO option will become more mainstream over the next decade. Note added on July 8, 2019. Here is an excellent blog from Andreessen Horowitz with more details, all about direct listings.
We can continue with Asim Qureshi's answer.
A few weeks ago, Airbnb IPO'd at $68. That day it closed at $145. A massive success for Airbnb, right? Wrong. The IPO itself was a massive success for the investment banks that led the round, Morgan Stanley and Goldman Sachs. They presumably made their underwriting fees and made their clients, who bought the shares for $68, a killing. But Airbnb ended up selling its shares for $68 a pop, when they were worth $145. Existing Airbnb shareholders were robbed in the order of $4 billion by banks that led them to believe their shares were worth way less. Now, you may be asking, could these reputable investment banks really screw their own clients? Within week 1 of arriving in the London office, I met a junior guy who was 24, 25 years old, and the first thing he'd told me was that he had just traded a sophisticated derivative with a Muppet client, who'd paid the firm an extra $1 million because the client was so trusting that he didn't check the price with other banks. Now you could think to yourself, is this some rogue guy who was just talking callously about clients? But his boss, who's a managing director, was sitting right next to him nodding and chuckling along. Greg Smith, former VP, Goldman Sachs. And that's why Slack did a direct listing.
The following answer is from John Framer.
They put shares of their company right onto the market floor. They didn't need banks to help them create any new shares. Also, they used the banks as associates instead of underwriters, so they didn't have to pay the huge IPO fees.
This is the end of the video. Thank you for staying until the end. You can now subscribe if you like the video more. Remember to also leave a like, it helps for the referencing on YouTube. The video is over. You can continue discussing this question in the comments, or find another question that interests you. See you next time.